Adam, how do you think the Fed addresses the curve steepener and like the 10-year kissing the 1% level this week?
First off, I think they're going to broadly accept it. Normally you worry about a yield curve steepening because you think that means that you've got a recession coming. Well, the recession's here. In this case, it's a good sign that inflation expectations and prospects for future growth are going up. So they may not bluntly say it, but I think they'll be more accepting of the yield curve steepening than most people expect. The second thing is, in terms of forecast, I think they're going to try to, perhaps not in the statement, but in the Q&A, we'll try to push back expectations for any rapid announcement of yield curve control or new measures. It's always possible they're going to surprise us, of course, and they have the interest in not tipping their hand when it's market-sensitive information. But I don't think that the Fed is yet ready to move to yield curve control, particularly that since there remains a great deal of uncertainty over the fiscal policy, and they don't want to be seen as playing in that political debate. That said, as Governor Brainerd has spoken about, as others in the committee have spoken about, and as I've written about, much less importantly, I think yield curve control is a very sensible way, looking at, say, the 10-year or the 30-year, but more likely the 10, to manage fiscal monetary interactions when you're going to have sustained raised deficits and not much ability to affect inflation expectations. Final point, if they are going to move towards yield curve control, I think they're more likely to talk about controlling the 2, 3, or 5-year, which I think is a mistake because, as we saw with QE in the past, when you target your activities on things that are close substitutes for cash, you have less traction on the real economy.